Hi and welcome to this week's Property Insider video. Today I asked Australia's leading housing economist Dr. Andrew Wilson what's next, and he's going to tell us what he thinks is next for our housing markets, for the rental markets, for inflation, for interest rate, as we dig into what's going on in our property markets. But if you want to keep up to date with what's happening to our property markets, please subscribe to our YouTube channel and click the little bell icon so we can keep you updated every time a new video comes out. Well, we're into June and the last 5 months have been like no other. In fact, if you look back, the last couple of years have been like no other. Only last year Australia experienced a tragedy which was unevenly distributed, an economic freeze and a media frenzy. Then this year our economy rebounded. Almost all the jobs that were lost have been replaced and our property markets defied all the doomsayers. So what next? Well, that's one of the questions I plan to ask Dr. Andrew Wilson, Australia's leading housing economist and chief economist of my housing market, and I look forward to hearing his beginning of the month update on what's happening in our property markets and our rental markets. Hello, Andrew.
Yes, hello, Michael, and onwards and upwards and onwards and upwards.
Well, our property markets have been bounding along this year. Buyers are out in force, owner-occupiers, investors and first-home buyers, at a time when availability of new supply is struggling to keep up, and that's, of course, pushing prices higher. In fact, a number of capital city property markets are already showing double-digit capital growth this year alone. But as always, Andrew, let's start with what's happening in our auction markets, because that gives us a good in-time indicator of what's happening on the ground.
Yes, look, certainly auction results are a window into the broader housing market activity levels, and we saw again on the weekend what we've seen for the month of May, and that was another flood of listings coming in. No sign of listing numbers really easing, Michael, even though we are heading into the typically quieter mid-year selling season. Another very big weekend, and it just capped off what's been a record May for auction listings across the board, not just nationally, but obviously in Melbourne and Sydney. Have never hosted the number of auctions in a May month in history. So it's remarkable just how many sellers are continuing to be prepared to engage the market. But what's really remarkable is that despite that week in, week out flood of listings over May, clearance rates really haven't tumbled at all. They've eased slightly, and so they should, given all the extra choices that buyers have now. But clearance rates were still above 80% everywhere except in Brisbane and Melbourne. Melbourne's eased down a little bit, but look, it's had 1,100-1,200 auctions every weekend over May. So coming back into the middle high 70s, I think is no disgrace.
Andrew, especially if you're locked down and you've either got to bring auctions forward or about 200 were withdrawn, weren't they?
Well, that's right. There was really no blip in activity. And I think that's the point, that memories are long in terms of what happened last year. And even though we had severe lockdowns in Melbourne, the property market continued to transact at lower levels. But once the shutdown restrictions were eased, the market was quickly back up and running again. And I think there's even a greater anticipation of that, particularly given how strong the market has been this year, and that any doubts about the underlying strength of not just the dynamics of the housing market, but also the economy are certainly nothing that are concerning buyers and sellers. So once the inconvenience of the shutdown is behind them, they will get back into the action. But there was really no impact over the first weekend of the shutdown, other than the draws that we typically see, which were above 10%. But the actual clearance rate was still held up just a little lower than the previous weekend. And no surprise, we've also seen auction prices rising over May compared to April. April was the typical holiday month. And in fact, we had a real hiatus during April in terms of auction numbers, not surprising. And that also means that a lower proportion of higher priced properties are in the market over that holiday month. And so when we bounce back, as we have in May, with a higher proportion of higher priced properties, we get that effect of prices growth. And that's just accentuating what is underlying prices growth anyway. But a very big month of May, Michael. No sign of the market slowing down, even though we're now into June. We have the Queen's birthday weekend in a fortnight, and then we really should see an easing due to those mid-year holiday distractions. And theoretically, we get a quiet July and then start to build again in August for the spring selling season. But the way this market is going, I think it'll just shift from fourth gear down to third gear at the moment.
And moving forward, the market has got all the underlying fundamentals still of the interest rate drop hasn't really worked its way through the cycle. Some of the pent-up demand has been taken up, and there also seems to be a little bit of buyer fatigue. People are getting a bit of sick of missing out at auctions, missing out at private sales, but there's still enough depth in the market, Andrew, for this to continue for some time.
Well, even though we had record numbers of sellers over May, Michael, in the auction market, and that would reflect generally in the broader market, we've had a record number of sales. So the point is that the level of the flood of listings into the market over May has really not tested buyer depth. Buyer depth is still standing up. So the question is, when will we start to see a significant reduction in buyers that have either satisfied their demands or are being priced out of the market? But at the moment, buyer depth is holding up with this flood of listings coming in. But I can just perhaps add to that, Michael, that even though auction listing numbers have surged over May, over the last 3 weekends, we have seen reduction in new listings. That's total new listings coming into the marketplace. So that's a clear sign of the winter hiatus coming upon us. I think we've got to understand that these auction numbers are reflecting decisions that were made 6 weeks ago. So the current decision making by sellers is certainly showing us a slowdown, as we would expect. So that will flow on into the auction market. So I think we're still going to see that seasonal decline in seller activity coming through. We're seeing clear signs of that generally now, but buyers still have quite a solid appetite for whatever property is being offered at the moment. In fact, solid, I think, is understating it.
I think it is. We're noticing two things on the ground. There is still FOMO. People are worried about the market moving faster than they can catch up with it. And that's creating some buyers to make some poor decisions, emotional decisions. They're buying on the rebound because they missed out on last week's auction. They're not doing all their due diligence. They're cutting corners. They're maybe looking at inferior properties. And that may catch up with them moving down the track. The other thing is we're noticing people are saying, okay, I can't buy in that suburb, so I'm going to move. And the ripple effect is starting to take effect where people are getting realistic about what they can buy in today's market just to get in.
Well, that's what we typically see, of course, Michael, the rise of the bridesmaid suburbs. We'll see that occurring now. But the interesting part of this cycle, and it is completely different to other cycles, and we should always recognise that is what happens, even if some of the differences are subtle from cycle to cycle. This is quite a significant change in what's happening, and that is that we haven't seen investors active in the market until now, but we certainly are seeing a rising appetite from investors. No surprise there. And that's likely to keep the market ticking over, particularly through the midwinter, because midwinter buying, because there tends to be less competition, can be a good opportunity for purchases. And I think that we'll see continuing growth in investor activity in that higher yielding, lower price point in the market through June and July.
Now, Andrew, while our housing markets have been performing strongly around Australia, we know the rental markets have been fragmented, with certain sectors performing strongly and others languishing. Now, I know you watch the rental markets carefully and you bring out a monthly rental report.
Yes.
So what have you found happening around Australia in our rental market?
Well, this must be of concern to tenants generally, Michael. We are seeing continued fall in vacancy rates. Vacancy rates are very low now. Most vacancy rates for both houses and units, and of course My Housing Market produces a vacancy rate for both houses and units in each of our capital city markets uniquely. But we are starting to see even the Melbourne and Sydney markets, which have been characterised, their unit markets, with high vacancy rates, in fact record vacancy rates in Melbourne and Sydney, which were a result of the COVID shutdown, as well as a lot of supply coming into the market over recent years with the apartment building boom. But that was really exacerbated by the border shutdowns, with a real lack of demand coming through from particularly students, of course, in those areas, which are particularly Melbourne, which are targets for overseas students renting. The other main change was increased supply from Airbnb, and we saw a flood of Airbnb, which are normally short-term holiday and accommodation tenancies, move into the long-term permanent market as a result of the shutdown, with no, of course, international tourists, and the state shut down as well. So Airbnb switched over. So we had less demand and more supply, which gave us record vacancy rates and rents falling. But we're seeing a reversal of that now, Michael. Clearly, vacancies in both Melbourne and Sydney apartment markets have fallen. In Melbourne, it's down by 10%. In Sydney, it's down by 5% over the past month and continuing to fall. It's still quite high, the vacancy levels, and vacancy rates are still high, but they've come down quite sharply over the last month. And I think that'll act to put a floor under what's been a steep decline in rents. But I think we shouldn't be surprised at that. We are starting to see, I guess, more of a normal churn in apartment tenancies. People are up and about now, less concerns over the economy. They're starting to activate those tenancy decisions that were perhaps put on hold over the shutdown period of the last year. As I said, the economy's doing better. So people are now looking, perhaps those early stage tenants are looking for their apartment to lease and attracted by lower rent. So that's one part of the increased demand. Of course, we are starting to see fewer first home buyers in the market because prices are squeezing them out, higher prices. So they'll be, again, increasing demand for tenancies. So there's two increased demand sources. And of course, the fact is we now have, well, until last week, we had our borders opening up, our state borders opening up. So travel for tourists and businesses has started again. And I think that's helped to take the Airbnb short-term accommodation back to what it was doing, offering short-term accommodation to business travellers and tourists, and taken away from the permanent market. So that's now an adjustment process that's underway. Of course, we need to keep our borders open, and that is slightly problematic at the moment, Michael. But there's no doubt that that part of the market, which was the underperformer compared to other parts of the market, is now heading back to perhaps a more normalised environment. But the rest of the market, Michael, and we're talking, of course, about houses for rent, is very, very tight at the moment. In fact, we started to see a bit of a blip upwards recently in houses to rent in Melbourne and Sydney, but that's reversed itself now. Vacancy rates in Sydney for houses are now under 2%, and they've fallen in Melbourne. I think part of that vacancy rate issue in Melbourne of it increasing was that we did have a sense of interstate migration, a movement out of Melbourne to perhaps northern states as a result of COVID issues. And maybe that'll reassert itself. But I think that was starting to adjust because there is an underlying shortage of rental accommodation in Australia, Michael. To see broadly vacancy rates below 1% is really a concern because it'll mean higher rents, it'll decrease rental affordability. And it has been driven fundamentally, I believe, by the lack of investor activity in the market over the last 4 years due to those credit squeezes that were enacted on investors. And of course, part of that drove itself into low building numbers. And even though we've bounced back with the home builder policy last year and building numbers are quite high, but they're fringe houses that are being built. Overall, our dwelling approval numbers are still well below the peak of 4 years ago. And this just, again, with a lack of investor activity, although it's picking up now, has meant an undersupply of rental properties. And that means higher rents, lower vacancy rates. And there's really no sign of an adjustment in the short term here. So I think this is of deep concern to a balanced housing market. And I don't think it's the solution there for many tenants is to just go out and buy a house, given how prices are skyrocketing at the moment. It's really moving beyond those in, I guess, lower income levels.
You can see moving forward there's going to be a shortage of apartments because there aren't many cranes in the sky. And the other thing is there's a long lead time for that. And as our markets move on and millennials feel more comfortable, some of them are now going to go back to moving out of their parents' home back into family formation stage. Yeah. So the millennials are going to be the drivers of the next stage of the property market.
Yeah, look, it's, as I said, to be in this point where we would likely see more demand as the house price cycle, that is first home buyers, start to be eased out of the market. And we're already in a position in most of our capitals, and that's the exception still apartments, inner city Sydney and CBD Melbourne. They're still the exceptions, but they're heading now more towards a balance between demand and supply. And we're going to continue to see upward pressure on rents. And house rents, Michael, have increased in most capitals by double figures over the last 12 months, which is quite extraordinary, and some pushing towards 20% annual increases in house rents. And I think the Brisbane market in particular, and other markets, Adelaide and Perth, are being confronted by higher levels of migration, which the first port of call typically is the rental market, which is acting really to push rents through the roof at the moment.
Well, rents are going up and so are property values, but there's lots of other factors to take into account when you talk about inflation. But Andrew, in the media recently, they seem to have been trying to talk up or scare us that inflation, the boogeyman's coming back.
Well, the relationship is obviously with interest rates. There, Michael, we know that higher inflation eventually leads to higher interest rates. Central banks want to quell inflation to avoid the wages prices spiral that we have seen through strong growth periods. So they're always ready to push the button. But we are so far away from that circumstances. It's just almost ridiculous to be contemplating it. We will see some adjustments to inflation over the coming 6 months or so, Michael, because we are moving out of an artificial inflation environment where, because of income support and price support, we've had inflation down to record low levels. They're already at record low levels, but even lower than that they were before COVID. And we will see some adjustment as those support packages ended and we get back to more of a normalised position. We will see upward pressure on building costs, of course, in particular when that building surge gets out of the ground from the home builder package, and that will work its way into inflation. And other factors such as the subsidy on child care packages is now being normalised, so we'll see childcare rising. We're seeing higher fuel costs, Michael, and now the price of oil is starting to move upwards. So these will work their way into higher headline inflation over the next couple of quarters. And we will get the screaming headlines telling us that all this means higher interest rates are just around the corner. That is nonsense. Underlying inflation remains at record low levels. That is, it takes out the volatility in the series, the headline series. And there's really no prospect for that rising, particularly given the Reserve Bank starts to look at higher rates once we start heading towards 3% inflation. We're half that at the moment. And of course, the key is not so much inflation, but incomes growth is still very, very low. We need an unemployment rate of 4, maybe 3% something to get incomes up to where they were back when we increased interest rates last, which, hey, was 10 years ago. And that's when we had 4% incomes growth. So it's a cheap headline, Michael, a really cheap headline that inflation will drive up interest rates. I think the Reserve Bank would be pretty comfortable with its prediction that they won't be considering rises until perhaps 2024. And even that's highly speculative. Again, I repeat, we haven't had an interest rate increase in Australia, official interest rate increase for 10 years. And when we did have it increasing, we had incomes growth of around 4% per annum. We are light years away from that. But getting it wrong on inflation will just add to the other factors that have been mistaken by pundits in terms of deep recessions, depressions, house price crashes, the cliff, and now we have inflation. So it goes on, but it's just good stuff to wrap your fish and chips in.
Well, it's not only the media, because the banks are now recommending that consumers fix interest rates.
Yes.
While variable rates are low,
Yes.
long-term 3 and 4 year fixed rates are starting to creep up a little bit, Andrew. What are your thoughts on that?
I'm very cynical about this, Michael. We know that low interest rates really do chop into the margins of banks. They are a business like any other. They want to maintain their profitability, and when margins are falling, they need to figure out ways of improving their bottom line. One of the mechanisms they use is to try to switch when we know that variable rates are going to remain flat for the foreseeable future. Just ask the Reserve Bank Governor, which I completely agree. But we know that they will look to other products, and that is the fixed loan product. I saw an advertisement the other day, Michael, that was asking consumers to consider that perhaps they could get off the roller coaster ride of interest rates, which of course we have had, and that therefore locking in an interest rate might be something to think about, a fixed rate for the next 2 years. Well, the Reserve Bank has said it's going to be at least 3 years since that they'll raise interest rates. Yeah, they could be wrong, who knows? But I do think it's a little bit of a cynical exercise to be speaking about the roller coaster ride, the implication for interest rates, when we know that interest rates now are dead and buried for the foreseeable future. The genie's back in the bottle. And perhaps it's a question we could ask of the senior or chief economists of those banks that are promoting a fixed rate on the basis that there will be a short-term increase in official rates, whether or not they actually support that position. I would be interested to see what the reply was. I think I know what it would be, though.
So do I. Well, at the beginning of our chat, I said I was going to ask you what's next. You've told us what's next with our property markets, with our rental markets, with interest rates, with inflation. I think we're finishing off with a really good understanding and a bit more clarity. So I look forward to our chat again next week, Andrew.
Yeah, thank you, Michael, and welcome to winter.
Yes, yes.